Hey, everyone. Welcome back to the Investing Iguana's channel. I'm Iggy, and today we're going to delve into a hot topic that's setting the financial world on fire, the bond market meltdown. You might have heard some pretty scary headlines, so we're going to break it down for you. We'll cover what's happening, why it matters, and what comes next. Stick around to the end because I've also got a bonus section debunking some popular misconceptions. All right, let's jump right in. So, what's going on with bonds? In short, the market's experiencing a meltdown. Bond prices have taken a nosedive, especially the longer-dated ones that are most sensitive to interest rate changes. According to Bloomberg, they've fallen about 46% since their peak in 2020. Here's why this is a big deal: bond prices and their yields have an inverse relationship. Basically, when interest rates go up, bond prices fall. This is rooted in the concept of time value of money. If someone offers you $1 today or $1 in a month, you'll take the dollar today. If interest rates rise, you'd pay less for that future dollar because you can invest the one you have now for higher returns. Interest rates are currently on the rise, and there are three primary factors contributing to this trend. First and foremost, the Federal Reserve has been actively increasing interest rates as a measure to combat inflation. By doing so, the central bank aims to slow down the economy and reduce the upward pressure on prices, thereby stabilizing the financial markets. Secondly, inflation is directly affecting bond prices. As inflation rises, the real value of fixed-income securities like bonds diminishes, leading investors to demand higher yields to compensate for the loss in purchasing power. This, in turn, pushes interest rates higher. Lastly, the Federal Reserve is also contributing to the rise in interest rates by selling off a significant portion of the bonds it had previously purchased. This action increases the supply of bonds in the market, which naturally leads to a decrease in bond prices and a corresponding increase in yields. When bond yields go up, interest rates follow suit. Therefore, the combined impact of the Federal Reserve's monetary policies, the ongoing inflationary pressures, and the increased supply of bonds in the market are collectively driving interest rates higher. You may be wondering, why should I even bother with bonds when I'm primarily interested in stocks? The truth is, bonds, particularly U.S. Treasuries, serve as a foundational element in the financial ecosystem that you simply can't ignore. Often regarded as the risk-free interest rate, U.S. Treasuries set the benchmark that influences the valuation of a wide array of financial assets, ranging from stocks to real estate. When bond yields rise, it triggers a ripple effect that causes the prices of these other assets to fall, sometimes quite rapidly. So, even if you don't consider yourself a bond investor, the fluctuations in the bond market have a direct impact on your investment portfolio. It's also important to note that U.S. Treasuries are not just another asset class, they are a cornerstone of the global financial system. Banks, hedge funds, and even central banks around the world hold treasuries as a must-have asset. They provide liquidity and stability, acting as the financial system's backbone. Contrary to some misconceptions, rising yields don't signal that the U.S. is less likely to meet its debt obligations. Rather, they serve as a real-time barometer of market sentiment, reflecting investors' views on economic conditions, inflation, and risk. Understanding the dynamics of the bond market is essential for anyone involved in investing, as it offers valuable insights into the broader financial landscape. The Federal Reserve has been actively working to maintain inflation rates as close to the 2% target as possible. To achieve this, they have been gradually increasing interest rates, effectively removing the economic punch bowl that has been fueling growth. This strategy has led to a slight slowdown in the economy, but it hasn't triggered a full-blown recession. This suggests that the Federal Reserve may be nearing a point where they could halt further increases in interest rates, at least temporarily. In layman's terms, this could signify that the tumultuous period in the bond market may be approaching its end. As conditions stabilize, we could witness a resurgence of investor confidence, particularly in riskier markets like stocks. This renewed confidence could set the stage for a potential rally in the S&P wink with tongue sticking out 500 later this year. The stabilization of interest rates and the bond market could act as a catalyst, encouraging investors to once again embrace risk and potentially drive stock prices higher. As we conclude, it's crucial to address a commonly held misconception that often reverberates through financial circles, the notion of a Treasury bubble bursting. This idea is fundamentally flawed for a simple reason. The term bubble implies that an asset is failing to meet its promised returns, which is not the case with U.S. Treasuries. These government-issued financial instruments have consistently delivered on their two primary commitments, providing interest payments and returning the principal amount at maturity. The U.S. government has a flawless track record of not defaulting on its obligations, making the concept of a Treasury market bubble not just misleading but factually incorrect. In wrapping up, it's essential to recognize that the subject of a bond market meltdown is intricate but incredibly relevant, as its implications can have far-reaching consequences that affect all types of investors. Whether you are primarily interested in equities, real estate, or other asset classes, understanding the dynamics of the bond market is invaluable. The complexities may seem daunting, but they are worth delving into because the ripple effects of bond market fluctuations can touch every corner of the investment landscape. Therefore, it's in every investor's best interest to be well informed about this critical component of the financial market. If you found this video helpful, please hit that like button. It really helps us to understand what kind of content you want to see more of. And don't forget to subscribe. Here at the Investing Iguana, we're dedicated to helping you navigate your financial journey with confidence and clarity. And guess what? There's plenty more where this came from. Stay tuned for our upcoming videos, where we'll tackle other interesting financial topics like the best investment strategies, understanding the stock market, and how to make your money work harder for you. As always, we're thrilled to have you as part of our Investing Iguana community. Your support helps us keep producing free content like this. Remember, every like, share, and subscribe goes a long way. Thanks for joining us today. Keep investing, keep growing, and we'll see you in the next video. Bye for now.